Good evening and welcome to another episode of Night Markets. Each week I'll be giving you my perspective on what's driving markets as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research at SFO. During the week, the majority of the main stock indices ended pretty flat in a week with minimal news flow, which appeared to be a quiet period of market activity in anticipation of second quarter earnings report we'll be seeing soon. The best performing sectors were small cap names and information technology specifically, with growth stocks outperforming their value counterparts. The week's activity may also have been influenced by investors' positioning adjustments, as index providers FTSE Russell was scheduled to rebalance its Russell indices after the close on Friday. Before we move on to markets specifically, let's just have a look at what the current situation is in the Middle East. Over the weekend, senior officials of Hamas stated that ceasefire negotiations with Israel regarding the Gaza conflict have not made any progress. They stated at a news conference in Beirut that the Palestinian group is still prepared to engage with any ceasefire proposals that could conclude the conflict. Despite the United States' support for Arab mediators, their efforts to negotiate a ceasefire have been unsuccessful thus far. Israel still insists that they will only tolerate temporary pauses in fighting until Hamas, which has pretty much ruled Gaza since 2007, has actually been eradicated, while Hamas still demands that any agreement must conclude the war and result in the complete withdrawal of Israel forces from Gaza. However, during the week, the Israeli Prime Minister and Defense Minister did, however, express their preference for a diplomatic approach to resolving the situation. So, as a result of the stalling in any negotiations, we've seen continued upward pressure in oil prices. Oil prices now actually up more than 12% over the last number of weeks, which will definitely not bode well for any inflation outlooks going forward. So starting with the US, the KRE Bank Index, a benchmark for the banking sector, experienced some robust performances during the week. The Federal Reserve is reportedly contemplating substantially lower additional capital requirements for banks than the regulators had originally proposed in the aftermath of the regional banking crisis we saw in March last year. The Fed's announcement that all 31 of the largest banks assessed at its most recent round of stress testing remained above their minimal capital requirements, and the market took this as a massive positive. This could potentially enable the banks to return capital to shareholders in the form of buybacks and dividends. In economic news, the Bureau of Economic Analysis released May data for the Personal Consumption Expenditure Index on Friday morning. The data indicated that prices, excluding food and energy, increased by 0.1%. This was a deceleration from April's upwardly revised 0.3% pace. It was welcomed by the market as a possible indication that the Fed could now start cutting rates as early as September. In political news, in a greatly anticipated debate between US President Joe Biden and Republican rival Donald Trump, the incumbent's erratic performance also weighed on markets slightly. Post the debate, Trump's approval rating actually skyrocketed while President Biden's fell quite substantially. So just looking at the market specifically, over the course of the week, the yields on longer-term treasuries actually increased despite the positive inflation news. A modest decrease in the shorter-term treasury yields was the result of the increased expectations for a Fed rate cut in September, and this resulted in the yield curve actually steepening. On the equity front, despite some relatively positive news, the S&P and the Dow Jones Industrial Average actually ended the week more or less unchanged, while the tech-heavy Nasdaq closed down 0.22%. Then moving across the pond to the Eurozone and the UK, European indices ended mixed during the week amid some heightened political uncertainty in France as the snap election called by President Emmanuel Macron approaches. Mixed confidence data were reported in the Eurozone during June. As evidence of diminished demand emerged, service providers, industrial companies, retailers, and construction companies became increasingly pessimistic. By contrast, consumers were marginally less pessimistic. A final reading of the Consumer Confidence Index confirmed an increase to -14 from the previous number of -16.2. This is the highest reading we've seen since February 2022, so it does look like it's moving in the right direction. In Germany, an unexpected decline in business confidence and an increase in unemployment underscored the German economy's continued challenging environment. The unemployment rate increased from 5.9% in May to 6% in June. Also in June, on the inflation front, the harmonized rate of inflation in France and Spain was reduced by lesser increases in petroleum and food prices, as indicated by preliminary data we saw out this week. In June, the annual rate in France decreased from 2.6% to 2.5%, while inflation in Spain decreased from 3.8%, which had been the highest level in over a year, to end at 3.5%. Eurozone government bond yields rose mostly as comments from European Central Bank officials leaning towards a more cautious approach to cutting interest rates further this year did add upward pressure on yields. And then just looking at the market performance, Germany's DAX rose by 0.4%, Italy's FTSE MIB fell 0.46%, and France's CAC 40 index lost 1.96% on those political concerns. And then moving further east, the Nikkei 225 index and the broader topic index experienced a 2.6% and a 3.1% increase in value respectively over the course of the week. This increase was attributed to the yen's historic weakness, which continued to bolster Japan's export-orientated sectors. The yen fluctuated at its lowest point in 38 years, rising from 159.7 to the US dollar at the end of the previous week to above 160 by the end of this week. The market was, however, expecting authorities to possibly start to intervene in the currency market to halt the fall in the yen, but only verbal intervention was actually provided. Consequently, the yield on the 10-year Japanese government bond also increased from 0.97% at the end of the previous week to 1.06%, as there's now a growing expectation of additional monetary policy tightening by the Bank of Japan. At its July meeting, the central bank is expected to provide a comprehensive overview of the strategies for reducing its substantial bond purchases in order to re-establish market functionality. Additionally, certain market participants are still considering the possibility of an interest rate increase, while others are uncertain as to whether the Bank of Japan would announce two significant initiatives during the same meeting. Investors did, however, seem to focus on the June core consumer price index print for the Tokyo area, which indicated a 2.1% year-over-year increase in inflation, surpassing consensus expectations and also surpassing the 1.9% increase we saw in May. The increase was primarily driven by services inflation, and it did spark speculation about the Bank of Japan's policy normalization. And then moving over to China, Chinese stocks ended lower for another week as a light economic calendar and concerns about the slowing economy seem to have curbed risk appetite. The National Bureau of Statistics reported that industrial profit at large companies increased by 0.7% in May compared to the previous year, and this is actually a decrease from 4% from a 4% increase in April. The earnings improvement was ascribed by analysts to the increase in commodity prices predominantly, which resulted in a boost in profits for mining companies specifically. Nevertheless, the month-over-month decrease was indicative of sluggish consumption in the context of China's persistent deflationary pressures and protracted property downturn. The week's declines were also further influenced by foreign selling. Bloomberg has now reported that global funds have now sold more than 50 billion renminbi of offshore shares through trading connections with Hong Kong since the beginning of June. Many of the Chinese companies have continued to disappoint investors with lower than expected quarterly earnings, further underscoring the economy's weak outlook. And then just looking at the markets, the Shanghai Composite Index as well as the blue chip CSI 300 Index both recorded slight declines for the week, while Hong Kong's benchmark Hang Seng Index slid 1.5%. And then bringing it back home, President Ramaphosa announced his cabinet after 2 weeks of some quite dramatic negotiations on Sunday evening. A compromise has seemed to be reached between the Democratic Alliance and the ANC over certain cabinet positions. The ANC has retained the lion's share, 62.5% of cabinet positions, excluding the president, deputy president, and deputy minister portfolios. This is overweight against the showing of 40% in the election, which would probably have been a better reflection of where voters stood. So despite a relatively positive week from a sentiment point of view, the all-share index ended mostly flat, with most of the sectors ending slightly lower, with the exception of the resources sector, which rallied by more than 2.5%. This was mostly on the back of strong commodity prices. And then just looking at the week ahead, definitely will be dominated initially by politics as the results of the first round of France's election becomes available. The election theme continues further in the week as UK voters also goes to the polls on July 4th. The US economic calendar is also jam-packed despite the public holiday on Thursday. We'll see JOLTS numbers and ADP employment reports, which serve as the warm-up act for the National Employment Report on Friday. Additionally, we'll also see 2 critical ISM reports for manufacturing and services, which could also give us an indication of the strength of the US economy. Locally, the markets will continue to unpack the announcement with regards to President Ramaphosa's cabinet finalization, as the economic calendar will be fairly quiet during the week. And as always, we'd like to end off the show with an interesting investment discussion we've had over the week. Politics are still at the forefront of most investors' minds currently, and it seems with the positive news that we have been receiving that it could bode well for the South African market. The fact that the rand actually closed below 18 rand to the US dollar on Friday was quite a big psychological level, and I think if we see some further positive news during the week, we could definitely be looking at a rand at 17, which would be great for inflation. Thank you for joining me this evening on Night Markets. Financial markets close at 5 p.m. Night Markets open at 6 p.m. Let's start the conversation.